We are definitely approaching critical levels when it comes down to the overall indexes here, especially the S&P 500. If you guys have been following the channel, I said that we would probably break 4,200, find a bottom right around that 4,150, and we are definitely pushing up against it. And I believe if earnings come in bad for both Apple and Amazon, we're probably going to break that 4,150. An end of year rally might just be out of the question here. If we can hold on to that 4,150 to 4,200 and earnings turn around both for Apple and Amazon, who carry heavy weights for the indexes, then I think we can have some good sentiment going into the end of the year. This is definitely a day-by-day scenario. And when we look at valuations, especially when we talk about your mega tech companies, obviously Google is going to be the first in line here. 23 PE ratio, roughly 19 times forward earnings. And so I want to break down Google's recent earnings. I also want to get a fair market value for Google because earnings actually came in pretty strong. Cloud growth was a question, and there's definitely concerns about their search engine going into the future here. Are they going to lose market share to Bing? Are they losing the race for AI? So there's definitely concerns, even though the fundamentals are still extremely strong in this company, and they are actually at a reasonable price, and that's why we're breaking them down today. So I definitely say overall, earnings have been pretty interesting here. You know, I had a top and bottom line beat for Google that sold off. Microsoft's valuation gets even more bloated because they are taking some market share and getting ahead in the AI race. This is not your traditional earnings reaction here where we get top and bottom line beats and then all of a sudden you see a market spike 5-10%. We're not getting these reactions anymore, and which is making me think that we are possibly heading into a new regime. And I'm just highlighting one of the defensive names that I brought up here, which was Verizon. If you look over the last few months with dividends reinvested, Verizon is now outpacing Google, Tesla, and some of your larger cap companies here. And another interesting dynamic that's taking place is that oil is actually dropping here, and that's bringing up concerns for me personally. It seems as though the oil market's starting to price in the fact that we could be heading into a recession. So we all know supply is very limited on oil. So what is causing oil to dip here is obviously going to be demand destruction that's taking place in the largest consumer of oil. Is the United States heading into a recession in 2024? You guys know my thoughts. I think by the first quarter of 2024, I would not be shocked if we're in a recession, but that does not prevent me from still looking at valuations and building a watch list and still building into some positions here. So if we look at the 5-day chart of Google, we can see that it definitely has fallen off from earnings, which we all know the price falling is definitely making valuation possibly more compelling. And so we're going to dive into that right now. Sentiment in the stock is fairly strong here. Most people do have it as a buy rating. We have price targets between 117 all the way up to 174, currently trading at 123. First thing we're going to notice when we look at a company like Google is that top line revenue growing extremely strong, but along with that, we're seeing margin expansion and we're seeing balance sheet growth. They're growing their cash position, they're growing their margins, and they're growing their top line phenomenally. They are definitely going to be a player when it comes to AI as well. You know, I definitely think there's a conversation to be made here that this could be the largest entertainment platform when we consider YouTube. They got the NFL package now going, and I'm willing to bet that there's going to be more and more developments here coming for Google. When we pull up Alphabet's financial statement here, first thing I do want to point out is that they grew their cash and cash equivalents by $6 billion. And this is going to be the power of a clean balance sheet and having a tremendous amount of cash on your balance sheet. Is right now you're pretty much getting a risk-free rate of nearly 5 to 5.5%. And this is just extremely strong additional income for these mega tech companies. We're comparing the top line revenue growth of 2022 versus 2023. It's about a 10% growth rate here. Still maintaining strong growth rates. When we talk about $200 billion, you know, that's a large sum of money. And so it gets harder and harder to get that double-digit compounded rated growth. But we're seeing here that they are still pushing that double-digit rate of growth, which for a lot of the mega tech companies is getting harder and harder to do. But we can see here Google is still maintaining that strong revenue growth. When we bring it down to a net income basis, we can see that there is margin expansion taking place. In the trailing 12 month, we see here that $27 billion of debt, they basically can wash out all their debt with $119 billion of securities and cash or cash equivalents. And so we have revenue growth, we have margin expansion, and we also have free cash flow growth here, going from 2019 of roughly doing $31 billion of free cash flow, now in the trailing 12 month, pushing over $78 billion of free cash flow. Revenue growth is picture perfect. Balance sheet is beautiful. Well-diversified business. but there obviously is some concerns with risk down the road. Now, the art of investing is obviously going to be understanding growth rates. How fast can this company grow? How efficient are they going to be with that growth? And we can see here on Yahoo, they're expecting them to grow nearly 18% over the next 5 years. And that seems awfully high because we're looking at their quarterly report, meaning that they're doing right around 10%. They're probably obviously going to get closer to 14, 15%. But 17 over the next 5 years, or actually technically 18% over the next 5 years, is extremely high growths when we're talking about the amounts of revenue that this company does. So to put that kind of growth rate on a stock, I think is very dangerous, especially when we think about what's going on economically. But let's take a look at what Stock Analysis has. And so I really like what Stock Analysis has here. They have them doing roughly 10% on average until 2027. I think that is a reasonable amount to use. So we're going to use 10%. So I'm using 10% revenue growth from years 1 through 3, 9% revenue growth from 3 through 6, and then 5% revenue growth from 6 through 10. When we look at historic EBITDA margins for the company, we can see here they do anywhere between 30, 33 to about 40% EBITDA margins. When we look at the EV to EBITDA, the multiple on it is sitting right around 16. The median is sitting right around 9. But let's be honest here, we're paying a premium for a company like Google because of the well-diversified business, the unbelievably clean balance sheet, and then lastly, they're maintaining at least high single-digit growth for an extended period of time, and not many other companies are really going to be able to offer that. So we're going to use a 15 multiple here. Now, what I want people to understand is I'm looking for roughly a 10% rate of return if I bought a company like Google. Now, the more risk I'm taking on with a company, let's say I'm buying a company I think is a little bit more risky, I would actually build a little bit more safety, looking for 12, 13, or maybe even 14% rates of return. With a company like Google, I'm actually being pretty conservative here with their growth rates. I think I'm actually being pretty conservative with their margins. And so I've already built some safety there. And so I would be happy owning a company like this and getting right around a 10% compounded rate of return. We get two price targets here. We get $94 from a free cash flow standpoint. It's really $105, but I put a 10% buffer in there. And then we get $102 from an EV to EBITDA multiple here. That anywhere between $95 to $105 on the stock is going to be a buy. And now before you guys flip out and think that I'm being crazy with my analysis here, I want you to understand something. When we look at the price action of Google, the 52-week high was $142 and the 52-week low was $83.45. Is it realistic that I can buy this stock between 95 to 105? And anything below 95 is just building more safety and building a higher rate of return in the future. And so I actually feel really good putting about a 95 to 105 price target on a company like Google. So hopefully you guys enjoyed that dive in, and we will see you in the next one.